Hi, I'm Daniel, and you're watching Unrivaled Investing. Today, we're talking about Sofi, S-O-F-I. I personally think that Sofi deserves to win more customers, but will shareholders deserve to win as well? So far, Wall Street seems to think so, because if you look at the share price this past month, it is up nearly 50%. But then you go, oh, wait a second, Daniel, you need broader context for where Sofi's been. And yes, it is down significantly over the last couple of years, down even since its IPO. I've done a number of videos. You can see red arrows marking several of the different videos where I'm saying, you know what, and you can check out my history here. I said too hard, valuation too rich, especially in many of the peaks. I said, nah, avoid it. It's just not there, even if you think it's attractive. So now, after it's gotten washed out, the stock down significantly, you're starting to see a little bit of a bounce. Is now potentially the time to buy Sofi stock? Are the fundamentals supporting it? Well, let's look at the fundamentals. You see net revenue continuing to explode over a multi-year period. This is the chart I like to see, folks, going from $400 million in revenue to $1.5 billion in revenue in 2022. Then you look at their adjusted EBITDA going from huge negative to positive 140. Okay, so positive EBITDA, does that mean you're looking at a company that's, doing real well with real profitability? Not yet, folks. You're looking at a business where stock-based compensation, share-based expense is still double the EBITDA figure that they posted in 2022. That's not quite what I wanted to see. If you look at it just for the fourth quarter, their EBITDA is roughly positive because of their stock-based compensation. So I'm looking at this thinking, they're still figuring it out, but hopefully 2023 is the year where you see them achieve GAAP profitability. And what's driving their growth? Well, you're looking at members and effectively people using their products or services. This is driving the fundamentals. When you see their members grow from under 1 million to over 5 million over a couple of quarters, couple of years, that means you're doing something that's working in this marketplace. You're disrupting, and you're potentially unrivaled when you're growing this quickly. Nearly 500,000 new members in the quarter, 50% growth year over year. What's going on that's driving this growth? Well, key aspect, and we're going to talk about this, is their deposit base. But not only are they growing historically, but they're looking at continued growth going forward with 2023. They're talking about, this is part of the reason why the stock price was up following their fourth quarter announcement, saying, hey, not only did we deliver better than expected results for 2022, but our guidance for 2023 is also very solid, expecting between 25 and 30% growth, and they're expecting positive quarterly GAAP net income in the fourth quarter of 2023. So later this year, they're expecting to start actually reporting real profitability, 20% incremental GAAP profitability. So that does give you a sense of, okay, maybe their margins long-term can be somewhere between 10, 20%. Incremental is after the effectively the cost to run the business. And so why are they growing? Why are they winning these new members? Well, Sofi got their national bank charter in 2022, and they're rapidly expanding their deposit base from $1 billion to $7 billion plus during the year. That's a huge amount of deposits inflows that they are getting. And they grew this by offering above market rates on cash balances. Yeah, you open a savings account, here's one, their advertisements, marketing themselves for 3.75. So when you're advertising an above market rate, when you're looking at Wells Fargo, Bank of America, JP Morgan, they're all offering much closer to zero for your savings accounts. And you can look at Sofi and it's closer to 3.75. That's why they're winning, is because consumers are saying, hey, I want to get some sort of return for my cash. I personally keep my investment accounts with Interactive Brokers. There's a link below, and the cash that you currently, the yield on the cash there is currently even above Sofi's at 3.82, I think, right now. And they generally adjust it, as the Federal Reserve raises rates, they directly adjust that, and you can see, on your investment accounts, the percentage or the dollar amount each day, during the month of, the interest that's accrued. So I personally use Interactive. You can see the link once again for that below. But Sofi is another winner relative to the mega banks that are offering closer to zero, because they're offering a much better, effectively cash rate than what you could get elsewhere. So they deserve to win new customers. And what are they doing with that influx, the billions of dollars of capital coming into their business? Because when you think about this type of business model, it's really important to understand that money that's coming in where they're saying, hey, we're going to pay above market rates. That's a liability for them, folks. That's saying, hey, this is a big cost for us. So if you're going to have this huge cost, you better have a great asset that you're going to be investing in, because otherwise you just have this huge liability, and that's a problem, because they're committing to pay that 375. What are they going to do to get more than 375 back? And what they're doing is, as you've seen this past year, dramatically reinvesting in personal loans. Historically, this is a student loan business. Student loan market is sort of mucked up because the federal government has been overly involved. The home loan market is frozen because rates have moved higher, and there's this huge, differential from where we were previously versus where we are now. So you look at huge declines in loan originations for both student loans and home loans. But on the personal loan market, that is still something where they are competitive. I wouldn't say they're unrivaled. I'd say they're competitive, looking at a lot of different products out there. You can shop around and there's just a lot of different personal loan offerings, and they're all very similar. A couple of years out, up to $100,000, it's going to charge a lot, between 8 and something like 23%. And you can see here, this is just one of the advertisements for it. But there's a lot of players in this personal loan space, and they're rapidly growing. They're just a small player at this point, a couple percentage points of the market share. And their question is, well, could they keep growing, in a rational approach? Now, will a winning formula for SoFi customers, these people depositing their money at SoFi, will this actually result in a winning formula for SoFi shareholders? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server, available for annual subscribers. I also recently launched 2 new investment courses for enterprising investors that want to be able to peel apart companies, either think about financial statements or think about valuations. A lot of people got burned the last few years, overpaying for stocks. So that's why I launched a valuation course as well. In full disclosure, this is not financial advice. And so as we look at SoFi, you see a CEO that's rapidly been buying up millions of dollars of shares for himself, between anywhere prices $7, $4, $5. He's been buying stock consistently. You look back to last year, May, June, even more recently, December, he was buying back stock, or he was buying stock for himself to the tune of several $million. This is what I like to see. I like to see that conviction from a CEO. Now, so far in this video, I've really just talked about their lending business growing. They do have the sort of AWS of fintech that they've talked about. The reality, though, is when you look at this business at this point, the vast majority of their profits come from their lending. Their financial services business, that's, hugely unprofitable at this point, thinking credit cards, investment accounts, and stuff like that. So that's going to get turned around at some point, in theory. Their tech platform, Galileo and such, they've made some acquisitions here. This is fairly small relative to their lending business. These personal loans, student loans, housing loans, that's closer to 200 million plus in contribution profit versus, the contribution profit of only 16 million for tech platform. So literally 10 times the size for lending. And this is something that's growing very, very quickly. So that is my focus. Thinking about this business, let's do very rough math to think about, okay, well, where is SoFi? Where could it be? They're guiding to around 30% growth this next year, around $2 billion in revenues. Let's say they're able to get to 10% profit margins after tax, after everything, real profit margins of around 10%. Keep in mind, hugely unprofitable still, because you have stock-based compensation. Stock-based compensation is dilutive, it's real expense. So you're saying around 200 million in profit versus, let's say, a market cap currently around $6-7 billion. You need to factor in around 1 billion shares outstanding. So $6-7 billion market cap versus 200 million in theory profit that they could get to in 2023 if they were able to actually get to 10% profit margins. They're not going to. They're saying, hey, by the fourth quarter, we might be gap positive. So I'm saying, like, rough figures, does this make sense? Is this potentially cheap? And I'm saying it's interesting. It certainly does have a lot of optionality if they continue to grow, but I have a couple other thoughts here. I personally, as in this environment where you're having real cash returns, once again, getting close to 4%, I think it'll be over 4% if the Fed raises rates on cash. So I like that, like, if you don't find something that's super duper compelling right now and a company returning that cash to you, you do get that 4 or 5%, that you could get from sitting on cash. So that's what's, interesting to me, considering that this is a risk off largely environment, despite things moving up significantly. Higher interest rates do make things tougher. So I personally look at SoFi and I'm thinking, I still want to see actual profits. And that might mean I'm late to the game. So far, that's mean sitting out and looking, avoiding a lot of pain. So I'm personally want to say, okay, I want to see real profits for this business before I actually start committing. Maybe I'm late to it. Maybe the stock rallies significantly from here. I'm willing to wait because I just did some rough math and I'm saying, hey, 30 times potential earnings, for 2023, assuming margins that they're nowhere near, is that really super compelling? And so then that gets to the next question of, like, how will their loan portfolio perform throughout a full market cycle? And this is a point that it's very easy to forget. It is extremely easy for financial companies to grow their loan books very, very quickly. You do what they're doing, like SoFi. You do what SoFi's doing, offer an above market rate. But that means you need to intelligently invest your assets. And that's only really tested in a tough recession where you say, oh, are you making intelligent loans? It's very easy for banks to grow with a terrible loan portfolio. But how will their loan portfolio perform in a tougher environment? And that's what I want to see, because personal loans, that can be a tougher space. We'll see how that plays out. It's a very competitive, commoditized space. I don't think SoFi is sort of special in that area where consumers are just like, oh my goodness, I love going to SoFi because I love the brand. They're going to SoFi because the rate's right. And do they really have they don't have an advantage on the cost side. Does SoFi have some sort of algorithmic advantage to saying, hey, we found these really quality personal loan customers, that we can trust to effectively loan money to? And so that needs to be tested. That part of the thesis, in my opinion, needs to get tested over the coming years. And I can wait. I'm personally comfortable waiting for this. And if you're right, if you're a mega bull and you are right on SoFi, then what you're going to see is a potential winner for years and years to come. And so my thinking, if you're right, once again, as a mega bull, I'm not a mega bull on SoFi. I'm trying to have a very detached, let's keep this as rational as possible. If they indeed are going to be a winner for, let's say, the next decade or next 2 decades, which some people think, then in that case, there will be many, many, many years of profitable growth. And then I'll say, oh, okay, I can get this at a reasonable and fair valuation. Maybe that means I pay up in the future, but I'm comfortable paying up for first share price if you've de-risked the business model to the point where you say, oh, I'm not worried that their personal loan portfolio will blow up. Now, management has talked about like, hey, we want to be smart about credit and we want to make sure we don't blow up. And that's part of the reason why their growth for 2023 is expected to decelerate from what they've done. They're only guiding to 25 to 30% growth versus the much higher growth rates they've posted recently, that 80% growth in their personal loan book. So they're clearly saying, okay, let's make sure we got the credit profile right for our personal loan book. So I want to see, okay, has the loans that you've done so far, are you able to sell them to the marketplace? The ones that you keep on your balance sheet, do they actually turn out correctly? So let's see that. And if you're able to prove a culture of conservative loan underwriting over several years, then you're looking at a potential multi-year, potentially multi-decade tailwind to, structural thesis where you say, okay, they've clearly got it right in terms of acquiring customers and they're doing it intelligently on the investment side. Then I can make it part of my personal journey. And that's what I want to see. Subscribers at unrivaledinvesting.com, they've seen this is what I'm looking for. That's the formula I'm looking for. And that's, historically how I'd argue the best personal hits have come from is where you see that formula of, oh, here's someone that's delivered. And I've called out these types of companies where this company has a multi-decade track record of delivering, like 18% annualized returns for for decades. And for some reason it's sold off or it's at a discount and then I buy it. Or, okay, here's a company trading below liquidation value. So it's this pattern recognition of saying, hey, I want that proven history. And after you've de-risked, after you've proven yourself, pay a fair valuation or get it at a discount. But I'd rather wait to see them prove themselves on the loan quality. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.